Hello everybody, nice to be here with you again, and we're gonna today do the stock analysis of six companies, and the six companies are Pfizer, PayPal, Novo Nordisk, Amazon, Metastock, and ASML. So yeah, let's continue. Okay, as we can see here, we have the first quarterly report for 2026. We have sentiments and the numbers. We have constant key takeaways. We have constant execution and progress across Pfizer initiatives. Clear result for guidance match in February view. Year-to-year revenue growth impacted by prior period comparables. Stable business activity and macro backdrop across both segments. Q1 Clever GPV grew 12%, excluding gateway conversions. Strong balance sheet and leverage level tracking to plan. Investor day schedule for May 14 in New York City. Okay, we have the guidances and all. Let's get to the numbers. The financial metrics show us that adjusted revenue actually dropped, as you can see here. Year to year, well, it's just showing you what is happening. The same goes for adjusted operating margins. The margins drop significantly, as always the EPS do. So yeah, organic revenue grew 3.6% in Q1 2026. That's what they say. Okay, merchant solution highlights. We can see that the small businesses changed by 1%, enterprise by 2%, processing by -9%, just not good. And in total, it's basically on the zero. Organic revenue is -1%. You can see that actually the financial solution highlights the digital payments, issuing, banking in total it just dropped, so there is not really anything good happening to the business right now. And also adjusting operating margins also dropped. Here we have the metrics on the scrap. I'm not gonna watch any more of this report because there was really nothing interesting for it to show. As we can see, the revenue is stagnating. The cash from operations, free cash flow is dropping. Net income somehow also is on the similar line to 2024, and the expenditures are a bit rising. They're trying probably to fix their problems, but as we can see here, I think it's not gonna really work well for them. The revenue growth of 2% and EPS and CF of 7, close to 7, is not really stellar. And for business like that, it's probably very, very low. It's after all fintech. The return on invested capital and assets maybe not look that bad with the operating margin on 24%, but again, the company isn't the margin is dropping. The ROA and ROIC aren't really that high. It's just way below that what we like to see. So even if it's not in the negative yet, hopefully we do not get there, but it's showing that they very poorly can invest their money and don't know what they're doing with them. The price target for a business and price itself is around $68 with current price of $65. To be honest, divergence of 2%, do I believe in Pfizer? Not really. Even if we take a look at PE metrics, they are very low, of course, and a lot of people say, yeah, look on this PE metrics, you're buying it basically for free. It's true, but aside from this, the business not really offer anything else. It's okay business when it comes to health. There is not like underlying problem here, and I understand, but in my opinion, Pfizer is not a good stock to invest, and I would rather avoid the stock for now until at least they show some positive growth in them again, and they start doing what they used to. Because apparently right now, if you invest in this company, you're just buying a little bit dying business, to be honest. There is nothing really much that is changing here, and there is also like growing competition for Pfizer. So even if they are leading now, they have like 70% of the brands under the name or something they claim, at least to be like this. The competition is growing, and apparently their services aren't as great as they would like you to think. So yeah, Pfizer for me in current growth is not very welcoming, and that's why the stock actually hammered down, because there is just no growth, there is no really big dividends, so the investors don't really want to invest in Pfizer. Yeah, so yeah, let's move to the other stock. The next stock, we have the PayPal, of course. PayPal used to be the big name in the fintech. Right now, it's more like kind of dying business that don't really want to grow. And to be honest, it's kind of reasonable to think like that. The best years for PayPal are definitely behind them. So, yeah, let's get to the numbers then. Probably that's what you are most interesting about. The PayPal the PayPal, very similar story. Like the revenue is actually growing, so at least that part is growing fine. The cash from operation and free cash flow not really that much. The net income grew a bit. Capital expenditures, they don't really have that much, so I wouldn't worry about it. But yeah, let's take for the future because that's what we're interested in. And future for PayPal doesn't seem to be actually that great. As you can see, this the growth estimates for PayPal for next 2 years of revenue, CFO and uh, EPS are not really great. 4% for revenue, 6% for EPS, and 12% for CFO. Nothing really great. And actually, it was revised down since a long time. So the people that were buying here were buying actually company that was operating double-digit growth. Right now, it's just here, so that's why people just run away from the business. They don't want to invest in it because their future is uncertain. There is, of course, growing competition, and even if the margins kind of improved a bit back, and the retro investment capital is not bad with the role, so the analysts give this price target at $47 with current price of $44. And to be honest, I think it's a bit better than Pfizer. Like PayPal is not as bad as Pfizer, of course, but they are in very hard environment because there is a lot of competition for PayPal, and the merchant growth is not really that much there. They don't really grow rapidly, their subscribers, let's say, so their clients. So even if on a day going like a number of transactions, the volume increased, it doesn't really change a lot. The prices also change of everything, so I wouldn't really assume anything big of that. In the end, it's all about numbers, and PayPal doesn't really seems to have they have great big place in the market, of course, but they stopped growing. So yeah, even if you take a look at PE and price to sales ratios, they are by all means, of course, it looks like it's cheap, but keep in mind it's cheap because their future also dropped, so people don't want to pay any more premium price for PayPal. To be honest, I think it's a bit better than Pfizer. Personally, I wouldn't really invest in this. There is not really good margins for me, and even if the company seems to be healthy because current ratio of 1.29, interest coverage of 14.82, with debt to assets of just 15%. Yeah, it's healthy company. Maybe somebody gonna take over it. I don't know. The monthly value of 15% is nothing bad here. But yeah, I would really rather wait for some better information for PayPal rather than right now buying it. Just just the just the return for you as investor is not very high here, and yeah, it seems to be value, but again, company is in the fields that the growth usually is expected higher. So for now, I will just say no to PayPal, unfortunately. Here we have Nova Nordisk, the presentation made by its team. We have the strategic milestones, the commercial execution drive competitiveness, 45 million people on obesity and diabetes treatment, 1 million Wegovy pills patients since US launch. Okay, so total Wegovy weekly TRX from 475k and NBRX 116k. Wegovy pills weekly TRX 207k with the best in the class launch. The Wegovy 7.2 milligrams approval across multiple regions. We have the regulatory approval of 6 and clinical returns initiation above 10. So it's okay, it's fine, of course. The finances focus on investment and deliver returns. 22.k billions of Danish crowns invested in R&D and commercials. 37.7 billions of Danish crowns returned to shareholders. Adjusted sales growth of 4% on care. Pricing headwinds partly offset by volume growth. So adjusted sales growth of -4 driven by pricing headwinds, partly offered by GLP-1 volume growth across the geography. As you see, the US is a big market for them. US operation here is in total is just the drop. In international operation just a little bit growth. GLP-1 diabetes in US kind of dropped. In international operations is kind of stellar, I would say. Insulin in US it's dropped, and in international it's also dropping. Obesity care is actually growing, which is a good thing. Rare diseases, the decrease in US to grow somewhere else. The Vagovipil has reached more than 1 million people since launch in the US. As we can see here, we have the Vagovipil compared to Vagovisec, to tirzepatide, and Oxford Pillion, whatever it is, sorry. And it has Vagovipil 16.6% best in class weight loss. So we have 20% MAC reduction, 50 million patient year to patient years of real world exposures, no drug interaction restriction. Okay, so they actually have a good product, but problem with this product is they don't know how to sell it actually. We have sales growth of 4%, the gross profit of 6%, and operating profit of 6% since in the Q1 2026. Okay, the 2023 outlook is rise driven by increased expectations for GLP-1 product sales. It's in Danish krona, of course, so yeah, you just keep it in mind. The capex of 55 billion Danish crown, okay. Free cash flow 36 to 46 billions of crowns. Overall, they of course wanted to sound good, but problems are here, and yeah, let's get to the company. Basically has not really much growth. So basically, they expected massive revenue growth on their, of course, the great drugs for obesity. Right now we have the net income of that also grew, but the cash from operation actually decreased from 22 billions to 15 billions. The capital expenditures, because they need to spend a lot to make drugs, actually increased, and because of that, the free cash flow is actually decreased. And if we take a look at the growth predictions, there is really not a growth in next 2 years. So yeah, this very similar situation to PayPal and Fisher, and probably PayPal most. There was big expectations here. That's what was driving the price high. And right now, this expectation are crushed each time they actually show the reports. The expected growth for next 2 years is basically zero. And even if actually company has the great return on investment capital and return on asset of 35 and 20% respectively, and the operating margin 45%, they have great product, but they just don't know how to sell it, or how to say it differently, they can't sell their great product basically. That's why the price target of 48 bucks and 48 bucks currently seems to be reasonable. To be honest, I would even expect a little bit of drop to price to more like $40 just to justify one thing, because let's take a look at health still. Okay, 0.8% in the current ratio, bit bad, but it's not really terrible. Interest coverage of 18% and debt to equity of 24%, not really bad. We have current dividend yield of 2.56%, and dividend payout ratio of 35%. Unfortunately for you, this dividend yield is not really good for Novo Nordisk, because people they're gonna compare it probably to this investment to the bonds, and the bonds offer way more than actually this. So even if they offer this dividend, it's not really any good signal. Even 2.5% may seem for some people okay. It's really not if you compare it, for example, to the bonds market that is way safer, and actually you're gonna expect similar return based on that. So yeah. And again, like P and price to sales, they're massively down, but there is a reason for that. Like, okay, even the price PE ratio forward is gonna actually increase, so it shows like the EPS not gonna really grow. The same goes for price to sales. They're gonna also increase, so a business has a great product, don't know how to sell it, cannot sell it, so because of that, Novo Nordisk also seems to not be good stock to invest currently. Well, 3 stocks in the row and 3 actually not great investment, I would say. That's kind of unfortunate, yeah, let's say. But yeah, let's move to the other companies. We have the Amazon, of course, Q1 2026 financial results conference call slides. And as we can see here, we have net sales of 181.51 thousand of dollars. We have the AWS segment of 21%, international on 22%, and North America net sales of 57% of that. Net sales TTM, we see kind of small growth here. Operating income up 30% year to year, which is absolutely fine. Operating income up 19% TTM year to year. We have net income up 77% year to year, and TTM up 38% year to year, which is absolutely good. The Amazon is very good company. It's not really surprised that they as usually present good earnings. Segment result, North America net sales up 20% year to year, and operating income up 42% year to year. TTM net sales of $436 billion, TTM operating income of $32 billion. International, the growth here is a little bit bigger. If you adjust from Forex, it's actually less, 11%, and operating income of 40% year to year, and up 6% FX adjusted. Net sales 168 billion, operating income 5.2 billion. The AWS net sales up 28%, operating income up 23% year to year, up 26% FX adjusted. TTM net sales 137 billion, TTM operating income 48.2 billion. Free cash flow TTM down 95% year to year. I don't really have anything to say about it. You will see in a moment why. So yeah, let's get to scrap to check Amazon a little bit more. Okay, here we have the Amazon stock. We have the revenue of 742 billions and the capital expenditures of 151 billions, the crazy capital expenditures, cash from operation of 148 billions, net income 90 billions, and free cash flow minus 2.5 billions. Why? Well, free cash dropped because the capital expenditures grew rapidly. I, to be honest, like this kind of thing because Amazon is known for rapidly investing in their own businesses, which I absolutely like. I like when they scale. I like business that scales. And do they do it good? Well, as we can see here, even with their scale, the revenue is still expected to grow 14%. The EPS and CFO well above 20. It's a really good growing company, and it actually was recently updated even higher. So it's growing even faster than it used to grow, which is a very good thing. If you take a look at the return on investment capital and total assets of 12%, nothing wrong with this kind of business they are in, operating margin of just 12%. And to be honest, price tag of $316 seems to be very reasonable. As you know, I invest in Amazon also. I believe long time in this business. I think there is a growth ahead of them. They are not afraid to invest their money. Very high quality business in my opinion. And this number of $316 per share of Amazon seems to be very reasonable. I will be surprised if in like, for example, 2 years, this price will not jump to $320. PE and PE's ratios, local minimals, forward PE even way less than the current one. The same goes for price to sales. Nothing wrong here. The company seems to be cheaper than before, which is a good sign for us. Debt to asset of just 20%, current ratio of 1.05%, which is very good. Interest coverage 35.61, excellent. Nothing really bad about it. So yeah, Amazon is the business that, I'm currently investing in, and I'm still believing this is good business to buy now. Amazon is strong, there is a growth, there is a health there, and Amazon has definitely good future ahead of them. So yeah, let's move to another stock. We have, of course, Meta presentation here, and as you can see, advertising revenue, but user geography in millions. We see that US and Canada is the biggest one. There is the Europe, Asia Pacific, rest of the world. And when you compare Q1 to Q1 of 2025 to Q1 of 2026, there is significant growth, so there is nothing wrong here. The revenue by user geographic in millions. The revenue again is like the US and Canada, Europe, Asia Pacific, and the rest of the world. Operating margins of 41%, nothing wrong here. Total income from operations in Q1 2026, $22.872 thousand of dollars and 56.311 of total revenue in Q1 2026. Expenses as percentage of the revenue, cost of revenue in Q1 2026 is 80%, research and development, they spend a lot on research development, 31%, marketing and sales 5%, and general administrative 5%. For somebody that is in the taxes, the effective tax rate of 23%. Net income in Q1 2026, 26.773 millions. Diluted earnings per share of $10.44. Capital expenditures, the quarter now is way bigger than in previous quarter of Q1 2025 to Q1 2026 is 19.840 millions, which is absolutely fine. Meta is again spending a lot of money into AI. I don't see anything wrong against it. They have a lot of money. It's better if they use their money somewhere else, if they actually are able to invest somewhere that may produce good returns in the future for us, of course. The family average revenue by person ARPP $15.66, which is fine. It still has kind of positive trend growing, so there's nothing wrong there. The ad impressions delivered year to year percentage change worldwide 90% in current US and Canada 13, Europe 17, Asia Pacific 23, rest of the world is 70%. And as we can see here, the Meta stock is, of course, growing with their revenue, with their operating income. The capital expenditures grew also dramatically because they invest heavily in AI. They are also joining the AI race. They joined quite long time ago, and there is nothing wrong with this. Of course, the companies want to do their best models to win this AI race. That's the norm of this world now, and yeah. Some people accept it, some dislike it. That's how it is now. The company is spending a lot of money. They see future there. And to be honest, the revenue growth of 20% and EPS and TEV of 70 to 20%, very good, very great. The growth ahead of them. Nothing wrong here. Fundamentally, it's strong business. Really like it. And operating margin of 41% and ROE and ROIC 21 and 8% respectively. Price to price target $820 to $550 now, 49% deviation from price. To be honest, Meta seems to be extremely undervalued now, and personally, maybe I will invest in future in this. Currently, I'm not investing, but yeah, Meta seems to be really undervalued now, and usually when there is this big disproportion between the price target and the price of the company tends to rise a bit. So I would say that for Meta, at least now, there is opportunity to grow. I wouldn't be afraid right now. Maybe I will even invest. I don't really like to hold a lot of companies, and I have like portfolio of 8 probably or 9. So for now, I will give it a look, but Meta seems to be reasonably good business to invest. PEs and PE ratios, the local lows, I would say local lows. Well, it's kind of low if you compare the last few years. It's very cheap stock. PE just 20 and PE ratio 2 years forward of 1366 with this growth, very small. Price to sales and price to sales future also very low. Nothing wrong here. Debt to assets 23%. Current ratio 2.6, extremely, and interest coverage 59.62. Very healthy business. There is no problem with debt or something. I wouldn't worry about it. Monthly value at risk 12.78%. A little bit volatile, but nothing really crazy. So yeah, Meta in my book, great business. It actually seems to be buy now, and yeah, it's second good business that we discovered today. Okay, let's get to the last company then. And the last company here is ASML. It's the Dutch producer of the machines to produce chips. So vital company for world of AI. Without this company, there is basically no production because nobody does this kind of machines in the world. They are like just the only real producer of them. So yeah, very important business and has very strong moat because of that. We have presentation in 2025 Q4, so not really yet recent, but that's what it is. And we have the total net sales of 9.7 billion of euros, gross margin of 53%, operating margin of 34%, earnings per share 7.35. Net system sales breakdown quarterly. Technology is RFE and EUV. and other, of course, by 40%, 48%. The net system sales 7.584 millions. The regions that they export their machines to is, of course, China, 36% of the client, US 70, South Korea 22, Taiwan 13, Japan 10, rest of the Asia 2. Sales in lithography units, EUV 14, RFFE 37, RFDR 5, KrF 29, and E-line 17. Net system sales breakdown yearly, we have 2025 net system sales, $24.474 millions of dollars. The regions usually is US, Southern Korea, Taiwan, Japan, and China. So it's basically investing in Asia most of the money, because most of the machines are exported there, of course, and they are kind of cutting on their China exposure because of the tensions. So keep in mind that maybe their sales gonna drop a little bit because of this massive massive China segment that recently is kind of America is trying, of course, to reduce export of these machines to China. Something to really keep in mind. Total net sales by end use. We have the memory, logic, installed base management. Nothing wrong here. It seems okay. We have cash return to shareholders. ASML intend to declare total dividend for 2025. It was, of course, a dividend 7.50 euro per ordinary share. Nothing really crazy here. I doubt somebody invests in SML for the dividend. They do a lot of also the share buybacks more than the dividends, which is probably good for some people that like volume. And ASML, as you can see, has $39 billion of revenue. It's growing. The cash from operation recently decreased a bit. Their capital expenditures actually dropped, so they have no concurrency in making these machines, so they not really that afraid to lose and the market share to anybody, because there is basically no competition in here. Yeah, there is some, but not really serious ones. Yeah. And the growth here is actually okay. EPS growth of 26%, CFO growth of 20%, and revenue growth of 70.28%. Very nice, very good growth. It's all, of course, on AI boom, but chips are basically used everywhere. So it's not only AI, it's kind of to use to everything what we basically have. So yeah, chips are important. The return on invested capital and the assets of 42% and 90%, operating margins of just 34%, and it's kind of stagnating. The margins are stagnating. They're just going somewhere around here with the recent improvement of ROI. So yeah. Price to price target, as you can see, the price recently jumped again to $1,790 euros to compare to $1,952. So basically, company is going to the price target quite often. What it means, well, as you know, it used to be my second biggest position in my portfolio. I was buying it well earlier, and I have very nice net income on that right now. But yeah, this company is great. It has very unique mode, basically no competition, and currently I understand one thing: it's a bit expensive. Okay, the P ratio of 59 and future PE of 30 may seem a bit expensive. It's definitely not the cheapest of company, and you actually pay right now premium. The sales go for price to sales, of course. So if you're not afraid, company still has like kind of growth ahead of them. It has extraordinary strong moat, so I wouldn't worry about their clients. A little bit fears around China, what US decide to do with the China client. They have massive pull of their money from China, so that's something to, of course, keep in mind. The debt to assets of just 9%, current ratio 1.56, interest coverage 286. Okay, and monthly value at risk 13.65%. Basically, I would say it's a bit expensive to buy ASML now. Company is great, it has growth, it is very healthy business, strong fundamentally, but again, with current price, I would probably wait for a little bit of the drawdown of the price to more like 1,500 levels, and then I would probably consider buying or accumulating more of the shares. For me, great business, as I said, nothing wrong here. It's just a little bit expensive because it's high quality business, and usually high quality businesses are kind of expensive. So yeah, you need to keep it in mind. So yeah, let's summarize it. The Amazon and Meta, good value, in my opinion, in my playbook, rather okay investments. I don't really feel bad about them, and with the current prices, they seems to be good buys. I wouldn't say they seems to be expensive or bad. There is a future for them, so I like them. The Fiserv, Nova Nordisk, PayPal, unfortunately kind of bad. Nothing really great going there. And with Fiserv, it's just it's cheap, but there is like not really. I don't see really a kind of comeback there. For Nova Nordisk, they have great product, but at least no future of growth in like next 3 years. PayPal kind of okay. They have the payback stuff, but also no growth. And I think they actually not gonna really grow as rapidly as they used to. So probably the best years for PayPal are behind them. So yeah, I wouldn't really feel comfortable with these businesses in my portfolio. ASML, fantastic business, but bit pricey now. So yeah, if somebody looking long term, ASML seems to be okay buy. But if somebody wants a little bit better price, I will probably wait for correction. Maybe it never happened. Of course, you also need to risk this. But yeah, ASML seems to be really great business, but a bit pricey now. So yeah, that'll be all from me. Thank you for watching this video and see you in the next one. Bye.